So thank you so much. So the statements that we've looked at so far were the income statement. We looked at the balance sheet, the statement of retained earnings, and the one that we're going to look at today is called the cash flow statement. And based on this slide at the corner on the right, we can see that all of the statements are interconnected. They are all connected in some way. So what happens is that different statements feed other statements. Okay, so some statements use another statement in order to exist. It cannot exist unless another statement was created and they're able to feed numbers into that other statement. So based on the arrows that we see here, we can see that the retained earnings statement is dependent or is fed by which statement? The retained earnings statement is fed by which statement? The income statement, exactly, because the retained earnings statement needs the net income in order to produce that statement. And you're going to get that net income, revenues less your expenses, from your income statement. And then the balance sheet is fed by the retained earnings statement. What does the balance sheet need from that statement? What does the balance sheet need from the retained earnings statement? For equity, exactly. On the balance sheet, we have our assets is equal to our liabilities plus our equity. So we have our assets amount, a liability amount, and for us to calculate what our equity amount is going to be, we need to have that amount coming from our retained earnings statement. Okay, and then at the end here, we notice that the balance sheet is feeding into our statement of cash flows. What does a statement of cash flows, give to our balance sheet? Cash, right? So we get the cash amount. Perfect. Okay, so just a very quick understanding of how these statements are interconnected, that they don't exist by themselves, they're really dependent on each other. So did anyone see any of these connections before I brought it up? Did anyone notice that in their studying that these different statements need different figures from different ones? Anyone noticed that before tonight? All right, some people saw it in the problem questions. Okay, a couple of people. All right. Well, if you didn't know, now you know. So this slide just reiterates what I just said, that these different statements are dependent on each other. I'm not going to stay much longer on this. So chapter 6, the statement of cash flows. Statement of cash flow. So when you hear the word statement of cash flows, what comes to your mind? What do you think about when you hear that? Revenues and expenses. Okay. How much money has been earned? Cash movement. Okay. Now, Ajithan, when you think of revenues and expenses, I want you to remember that, okay? You said revenues and expenses. That reminds me of the income statement, correct? Exactly. Now, does the income statement, for example, let's be more specific, revenues, does it matter when we receive cash for us to recognize something as a revenue? No. Does it matter when we spend cash for us to recognize something as an expense? Exactly. So when we think of revenues and expenses, we're thinking of the income statement, and we don't care about cash flow. So this statement is called a cash flow statement. So it must be different than the income statement. It must be different than just recognizing revenues and expenses. For this statement, the only thing we care about is when we receive cash and when we have to spend cash. So this is where the difference lies. And I like that you brought up revenues and expenses, because now we all get to see that the revenues and expenses is for the income statement, and the cash coming into the company or business, and cash going out of the business is what we're going to be considering in a cash flow statement. All right, and somebody rightfully said, Kansas said cash movement. Okay, cash movement. Does everybody understand that distinction? How it's easy to confuse revenues and expenses with cash flow? Did everyone see that mistake? Okay. So we need a statement of cash flows to get an idea of how much money we have. How much money do we have in the business? So as I said before, it summarizes our cash inflows and the cash going out of our business over a period of time. So, and the last point here, we talked about it. We can see how the statement can be similar to the income statement, but we can also see, and it's very important for us to see, how this cash flow statement is different than the income statement. So can someone just summarize really quickly, why is the income statement and the cash flow statement different? Anyone able to summarize that for me? Just a couple of sentences. Okay, so Samin says cash flow includes increase and decreases of what? Increases and decreases of? Somebody says the income statement requires when the service or expense was taken in the current year, not when it is paid. Okay. Cash from different activities. Yes, I mean, income statement deals with accounts not related to cash. Okay. So somebody says cash flow deals with when cash comes in and when we spend cash. That's right. So that's what the cash flow statement is dealing with, when cash comes in and when we spend cash. The income statement deals with revenues. That's when we earn income, when we've earned it, while we also deal with in the income statement with expenses, and that's when we are using up something. Okay, we're using up something in order for us to earn revenues. Okay, so this slide really shows you the difference. For revenues, we recognize them when they are earned. Whereas for the cash flow statement, we're dealing with cash inflow. Cash is coming into the business. Now, when we earn revenues, cash can come into the business when we earn revenues. But sometimes cash does not come in. Instead, we use an account called accounts receivable, okay? So sometimes cash comes in when we earn revenue, sometimes it does not. Yeah, the beep is my fire alarm, and somebody needs to get it fixed, but it has not, they have not fixed it as yet. Sorry about that. All right, so for expenses, we are going to recognize those when they are incurred, when we use up, when we're using it up. But for cash outflow, spending cash, right, means that cash is flowing out of the business. And then so revenues less expenses leaves us with a net income, whereas our cash inflow less our cash outflow leaves us with a net cash flow. Can we see that difference there? Is it clearer now? Okay, great. And this just reiterates exactly what I just said. Revenues less expenses gives us a profit. Cash inflow less cash outflow gives us a net cash flow. All right, so at the beginning of last month, your bank account had $10,000. At the end of the month, your bank account balance is now $8,000. So your bank account, the cash in your bank decreased by $2,000. Why do you think that happened? Why would your bank account decrease by $8,000? What did you do? Sorry, by $2,000 to $8,000. You used your cash. So cash went out, right? Cash outflow, exactly. Cash went out of your business. Okay, so how did the business get from the cash balance at the beginning of the year to the cash balance at the end of the year? So it's exactly the same thing with your bank account. So in your bank account, you had 10,000. Now you realize now I only have 8,000. You're going to your transactions and your activities in your e-web, your e-online banking, and you're checking to see how did I end up spending $2,000. You can see exactly where your money went. Okay, some of it went to Uber Eats, some of it went to paying a bill, some of it went to gas, some of it went to, there are many different transactions that you will notice as to why your the balance in your account has gone down, the cash in your account has gone down. Businesses are able to do the same thing. With a cash flow statement, it's like being able to double check the activities of your checkings account. It's the same thing that we're doing in the business when we produce a cash flow statement. We're able to check to see the activities that shows us exactly where our cash is going, but also where our cash is coming from. So parts of a cash flow statement, the first part in a cash flow statement is the cash from operations. Cash from operations. The second part is cash from investing activities. And the last part is cash from financing activities. Now, it's very important for you, for this course, for your exams, to be able to understand the difference between these three parts of the cash flow statement. Very, very important. Understand the difference between these three parts of the cash flow statement. So cash from operations. So cash comes into the business and cash flows out of the business whenever we're dealing with selling goods and services, okay? So when cash comes into the business, when we sell goods and services, what does that remind you of? What do we call that? When cash comes in because we've sold goods and services. Revenues, exactly. So sometimes when we make revenues, we earn revenues, we also get paid in cash right away. If not right away, eventually we may get paid in cash. But by selling goods and services, we also have cash going out, right? So again, as I said, you have to spend money to make money. So we think about all of the things we would have had to spend cash on in the regular operations of our business in order for us to sell our goods and services. So those are the different transactions we'll see happening in the cash from operations. The cash from investing activities, these activities are all of those activities that deal with buying or selling long-term assets. So if you buy a long-term asset, then that means that cash is going to go where from your business? Where is the cash going, in or out? If we buy long-term assets, cash is going to be going out. Cash will go out. If we sell long-term assets, then cash is going to come in. Exactly. All right. So cash from investing activities deals with all of the transactions that deals with the buying and selling of long-term assets. Now, the last one is cash from financing activities. And we remember from the first class that whenever you're starting a business, you can raise finances for your business in two ways. The first way is through equity, right? So you can raise funds through equity transactions, and you can also raise funds for your business through another type of transaction. What is that called on the accounting equation? We can earn finances for our business through equity, and what other way can we earn? Capital contributions count as equity. So what's the other way? Loans, exactly. So liabilities, right? So activities involved in raising cash or repaying cash to third-party banks or owners of the business. So if we are going to be earning cash or raising funds through equity, if we can raise funds through liabilities like loans, then that is going to cause our cash to go up. But sometimes there are situations where we have to pay back these loans, or we have to pay amounts to our owners, right? So these are situations where our cash is going to go out. Okay, so just think of a cash flow statement as your e-web for your bank, where you go into your checkings account and you can see that there are a bunch of different activities. But in this cash flow statement, we take it to a next level where it's not just about the activities just splat out on the paper in any haphazard order. But what we try to do in the cash flow statement is we try to group these activities into 3 different categories. The first one is cash from operations. Cash from investing activities is our second one. And finally, cash from financing activities. Correct. Somebody says buying shares. Well, that counts as in financing activities. Exactly. And the reason that that counts in as financing is because that is going to be a part of equity, right? So we're either getting cash in through equity or cash has to go out through equity. And one of the ways that we like, but that some businesses, well, not some businesses, publicly traded businesses are able to raise funds for their business is by issuing shares. So if we issue shares, people have to buy the shares from us. When they buy the shares from us, what do we get in return? What do we get in return when we put our shares on the stocks on the stock market and we issue these shares, we sell them? We're going to be getting cash, correct? So that's one way that we can raise funds. But if the owner is not publicly traded or they don't want to issue any more shares, they can say we need to raise funds. Then let's forget about equity for now. Let's raise funds through liabilities, and they might go to the bank and get a loan. All right. So the 3 different categories for a cash flow statement: operations, investing, and financing. Now, if you're stuck, you're like, is this financing or investing? Investing only has to do with long-term assets. That's it. Long-term assets, buildings, vehicles, long-term assets. As long as it has to deal with raising funds through your liabilities or equity, it'll be a financing activity. Cash can come in due to your liabilities when you get a loan, but cash can also go out when you have to repay that loan. Do we understand this slide? Great. So in order for us to create a cash flow statement, we need 2 things, right? So we have to look at the income statement. From the income statement, we need the net income. And then we also need to see if there's any non-cash expense. What does non-cash expense mean? Non-cash expense means that we don't have to spend any cash, right, in order to pay for this. So an example of a non-cash expense is depreciation. Now we can see that on our income statement, we have our revenues, we deduct our cost of goods sold, that gives us our gross profit, and then we can deduct our operating expenses, and that gives us our operating profit. Now, an operating expense that we normally deduct is called depreciation expense. And we know that what depreciation does is it reduces the value of our long-term assets. So it's going to cause the value of our asset to go down. For example, we have a car. We know that the car is worth $20,000. Once we drive off of the lot, the car is now worth $15,000. Did you lose money? Did you lose money out of your bank account because your car is worth $5,000 less? No. Some people said yes, and some people said no. If your car's value goes down, your bank account stays the same. Your bank account isn't going to go down because the value of your car goes down. And that's very important for you to understand. That's why we call it a non-cash expense. Exactly. We are not paying it a depreciation expense from our pocket. Thank you. We're not paying depreciation expense from our pockets. No, it's a non-cash expense. It's just meant for us to have a true economic value of that particular long-term asset recognized on our balance sheet. That's the purpose of the depreciation, but it does not affect our cash. So we're going to need these two figures, and you'll learn why we need to have the non-cash expense figure in order to produce our cash flow statement if they have non-cash expenses. Then the next thing that you'll need in order to produce a cash flow statement is the current year's balance sheet and the prior year's balance sheet. And the reason why you're going to need that is because you're going to have to adjust for the movement in working capital. Now, working capital can be a very intimidating term, okay? It can be very intimidating, working capital. So, but when we think about working capital, we're thinking about our current assets and our current assets and our current liabilities. So we're going to be looking at the change in inventory, change in accounts receivable, those are all current assets, and the change in accounts payable, that is a current liability. So these are the things that we're going to need. Now I'm going to explain to you at some point really soon what we use them for. How do we use this in order to produce a cash flow statement? Okay, so this is an example of an income statement for company X. The date that it's prepared for is the year ended December 31, 2020. We have here under operating expenses, a depreciation expense. Depreciation expense here is referred to again as a non-cash expense. What does that do to this net income figure here? Depreciation expense, how does it affect our net income? My question is, what will happen if we did not have a depreciation expense? What will happen to our net income? Anybody knows? It will increase, exactly. Net income is going to go up if we do not have a depreciation expense. So think about our cash flow statement. We're only looking at things that affect cash. If we were to produce an income statement and we were to say, let's start our income statement by using our net income. Let's say, I want to produce a cash flow statement. I'm going to start making my cash flow statement by the first number I'm going to have there is my net income. So I'm going to look at my net income. That's going to be the first number I write on my cash flow statement. Net income, $12,250. So that's the only number we have, net income. $12,250. True or false? $12,250 is how much cash is in our business. True or false? Correct. False. $12,250 is not how much cash is in our business. $12,250 represents profit. So if I started my cash flow statement with net income, and I wanted to take this number and push it closer to what cash amount in my business is, what will I do to the depreciation expense? Okay, repeat, I like that. So we understand that the net income is different than the cash in our company. It's different. And we know that depreciation expense makes net income less. So if I start my cash flow statement with the net income amount of $12,250, and I want to push that number closer to what it would be if it was the total cash amount in our business, what will I do to the depreciation expense? Will I add it or take it away or take away depreciation? Okay, now I'm seeing equal adds and takeaways. Can one person tell me why you think we take away? Please, I would really love it if you can say it like on with voice, so everybody else can get this, because this is a really a part that a lot of students confuse. And if I can get everyone to understand this part, we will be set up for success. Why take away depreciation expense from net income?
I'm not exactly sure, but if I'm not mistaken, you would take away the depreciation expense from the net income because, let's say, for example, it's a car, so that depreciated 5 grand. Now, your value on that car is now 5 grand less, and so just like your overall what you have is now worth 5 grand less. I
Okay,
don't really know how to explain it, but
okay, I get you. So your value of your car is $5,000 less, right? That's correct. But does that affect your cash in your bank account?
no.
No, it does not affect the cash in the bank account. So this 12,250 right now is less than what cash is in our account because they took away the 3,750. Can we see that? The 12,250 is less than what cash should be in our bank account because they deducted $3,750 of depreciation expense. Right. Okay. So the answer is we have to add it back. We add it back because we're trying to get closer to how much cash we actually have. And because the depreciation expense has nothing to do with cash, we're going to increase the net income figure by 3,750. We are now a little bit closer to what the cash is in our business. Do we understand that part? Kind of, okay. So step one, start from the net income, right? Step two, add back any non-cash expense. So net income, add depreciation expense. That's the first thing you do under this category, cash flow from operations. How can I make that easier for you to understand? Okay, this is a pen, right? This pen is worth $10. Okay, it's not a good idea because a pen is not a long-term asset. Okay, you have a car, okay? The car is worth $5,000, right? $5,000 is what your car is worth. It's depreciating by $100 in 2022. And at the end of 2022, your car is going to be worth $100 less in value. So your car is now worth $4,900. The $100 in depreciation expense goes onto your income statement. Revenues as expenses gives us a profit. So that net income figure, if we did not deduct the $100, that net income figure will be $100 more. But because we deducted the $100 of depreciation expense, which is a non-cash expense, that net income is now $100 less. And that's fine. The net income is supposed to be $100 less because that's the profit. But your cash should not be $100 less because depreciation does not change our cash. So if we start from net income, in order for us to get closer to what cash is, we have to add back that $100 of depreciation. So this is an extract of what a cash flow statement looks like. We have our net income, add back our depreciation, or a gain or loss on sale of a non-current asset, adjust for movement in working capital. So if inventory increases, what will you do? If inventory decreases, what will you do? And we'll discuss that next. If receivables increases, what will you do? If receivables decreases, what do we do? Now, if accounts payables increases, we have something to do. And if accounts payables decrease, we do something else. Okay? So I really hope that you in some way understand the depreciation part, because now we're moving on to the last part of operating activities. Okay? Any questions before I move on, please? Any questions? Yes, you will always add the depreciation. You will always add the depreciation, okay? Always. So if you don't understand it, then you will always add it back, okay? So someone wants me to explain the depreciation one more time, but what I'm going to do for now, I'm going to leave it alone for a bit. I'm going to move on to something else, which is this part, and then I will explain it again, okay? So working capital, the formula is current assets less current liabilities. And we see here in brackets our current assets that we're looking at are our receivables and inventory. And the current liabilities we're going to be looking at is accounts payable, just like you saw here in this diagram. Inventory, receivables, payables, okay? Now let's go back to math, okay? Let's go back to math, simple math, don't worry. Simple math. Receivables plus inventory minus accounts payable is the formula. If working capital goes down, right? If working capital is going down, if this goes down, then what has to happen for this to go down? For non-cash working capital needs to go down. What has to happen to these variables for this to go down? All right, payable increases. Good. So for example, if we had here current assets as, I'm gonna come out of this so I can grab a drawing tool. All right, so let's just say that this receivables is 10 plus inventory is, and this is equal, minus accounts payable of 4, all right? And this is equal to our non-cash working capital of $12, all right? Now, if accounts payable goes up, for example, to $6, what's going to happen to our non-cash working capital? What happens if accounts payable changes to $6? It goes up. What happens to non-cash working capital? It's going to go down. Okay, correct. Now, what happens if our receivables goes down? What will happen to our non-cash working capital? What happens if receivables goes down to $5? Non-cash working capital goes down. Same for if inventory goes down, right? All right, good. So we understand how that's going to go up and down, right? So what will happen for working capital, to go up? What will have to happen for working capital to go up? For this to go up, what will have to happen to these variables for working capital to go up this time? Decrease in accounts payable, good job, or what else can happen? And or receivables and inventory is gonna go up. Very good. So let's think cash now. If receivables are going down, receivables goes down, accounts receivable. We make a sale. We give them our end of the bargain, a good or a service. They give us back nothing because they'll pay us later. So we have receivables. Now our receivables are going down. Less people are owing us. What's happening to our cash? Very good. Cash, somebody says less cash inflow. If receivables are going down, then is that cash coming into our business or going out? In. Very good, coming in. Now, if receivables start going up, more people owe us. What's happening to our cash? Less cash, exactly. So whenever our receivables have gone down, are we going to add that to our net income? You remember we started with net income, we added back the depreciation. If receivables are going down, we understand more cash is coming in. So are we going to add that to our cash flow statement number, or we're going to take it away? Add or take away a decrease in receivables. Good. Now, if our receivables start going up, what are we going to do to that net income add back depreciation figure that we have so far in our operating activity section? Receivables is going up now. We're going to subtract it exactly in our cash flow statement. Inventory is going down. Inventory now is going down. That's another current asset. Inventory is going down. How does that affect cash? How does inventory going down? What does that mean? What causes our inventory to go down? Yes, why? Exactly, a sale. We're making a sale. Our inventory is going down. So that should increase our cash. Good job. But then once our inventory starts going up, what are we doing for our inventory to go up? What causes it? Exactly, we're spending, we're buying more inventory. So that means our cash is going to go down. So if inventory is going down, are we going to add or take away in our cash flow statement? And if our inventory is going up, what are we going to do in our cash flow statement? Take away. Now let's move to the current liability. Remember, working capital is current assets less current liabilities. Accounts payable is going up. How does that affect our cash if accounts payable is going up? Remember what accounts payable means. Accounts payable means we are owing people now. Accounts receivable, they owe us. Accounts payable, we owe them. So if our accounts payable is going up, that means that we are, are you sure? If accounts payable is going up, what does that mean? What are we doing for accounts payable to go up? What causes accounts payable to increase? It means that the business is doing what? Borrowing more. Exactly. If we borrow more, are we spending our cash? No. So that means our cash should be going up. So we will add it. But if accounts payable start going down, it means that we are doing what? We are repaying the things that we owe. We're paying it back now. So that means that our cash will be going down. Somebody says, so it's increasing because we are borrowing? Yeah, so it's increasing because whenever we buy things, we are not using our cash to pay for it. We're pretty much buying things on credit. We'll pay them later. So accounts payable goes down means that we are repaying the things that we owe using our cash. If our business borrows something and we don't pay, if our business buys something and we don't pay in cash, we buy it on credit, then that's an accounts payable. We have to pay that, but we're not paying it right now. So the more accounts payable goes up, the more cash is free for us to use for other things. So we'll add that to we'll add the increase in accounts payable to our cash flow statement under operations. But when we notice our accounts payable going down, it means the people that you owed money, you're paying them back. So your liability is going down, but your cash goes down. Does that make sense, the room? Okay. Any questions? No questions? Okay, so this is what we just did there. Everything I just explained, everything you just answered, this is it here. We start with the net income, okay? We add any non-cash expenses, we add it back, depreciation, we add that back. And then if your inventory is going down, then that means that you are getting more cash in. So you're adding back a decrease in inventory. If your receivables is going down, that means more people are paying you back in cash. So you add that to your cash flow statement, okay? If your inventory is going up, that means you're purchasing more inventory. So your cash is going to go down. So you deduct it. If your receivables is going up, it means more people are owing you. More people are not paying you in cash, so you deduct the increase in receivables because it will reduce the cash that's available for you. And this gives you your cash from operations. For the company to be healthy, cash from operations needs to be positive. Are we good with this so far? We'll do practice, so it'll help. All good with this so far? Yes. Anyone else? Only 2 people are good with this. Everybody else is already checked out. All right. So again, net income plus depreciation. Add a net decrease in non-cash working capital. So we know what those are. Deduct a net increase in non-cash working capital. This gives us our cash from operations. Now, again, why do we add back the depreciation expense? Somebody asked me that. I said, well, I'll go back to it. So this is me going back to it. Does anyone else here think they understand why we add back the depreciation and would like to use your voice to give somebody else maybe just a different words just to see if maybe you are able to explain it better than I am? Go ahead, Sally.
Well, I believe it's because when there's a depreciation expense, it has no effect on the cash flow. It's actually a decrease in the value of an asset. So it has no effect on the cash flow. So we add it back to the statement because when there's a depreciation expense, there's just a decrease in the value of asset, not a decrease in amount of cash available.
Exactly. Thank you. So when you deduct depreciation in your income statement to arrive at your net income, Okay, that's okay for us to do that. But when we're creating a cash flow statement, we only want to look at things that have an effect on cash. And depreciation does not have an effect on cash. And so what we do is we add it back to the net income, because our goal is to get our net income figure. We use that as a starting point to get our net income figure as close to how much cash we actually have in our business as possible. So the first thing we do to get that net income figure close to cash is that we add back any non-cash expense. Anything that has nothing to do with cash, we're going to add it back. Depreciation is one of those things that we deducted in our income statement to arrive at our net income. So in our cash flow statement, we add back the depreciation. Does that help? Is that a little bit clearer? Honestly, if you do not understand it, why we add it back, just add it back. Honestly, just add it back. Once you see depreciation, add it back. Someone says, do the numbers for non-cash working capital come from the balance sheet? Correct. Because I said before, in order for us to produce a cash flow statement, unless the question says inventory increased or inventory decreased by this amount, or receivables increased or receivables decreased by this amount, or accounts payable increased or accounts payable decreased by this amount, unless they just tell you, make it easy for you, what they can do is give you a current balance sheet and a prior year's balance sheet, and you have to compare, okay, 2019 and 2020. All right, 2019 accounts receivable was $500. In 2020, accounts receivable is $1,000. So accounts receivable is increasing, right? So the other non-cash expense would be a gain, but you wouldn't know. It'll just be depreciation for this course. Sally, go ahead. Or maybe that was your old hand from before. All right, so chapter 6, problem 8. Please go to chapter 6, problem 8. No, here it is. Is this it? I think this is this chapter 6, problem 8? Because I remember last time your numbers were different. Oh, I hope it's similar. If it's not the same, I'm not totally disappointed by that either, because it gives you an extra chance to look at your question with fresh eyes to see if you really understand what we did in lecture. So last year, Rational Co. made a net profit of $500,000 in the year. Depreciation expense was $250,000 during the year. Accounts receivable decreased by $50,000 and inventory increased by $250,000. Trade accounts payable did not change. So what will your cash flow statement look like? Take 2 minutes, please, just to go over, take a pencil, jot it down on your paper, exactly how you're going to work through this one. What I can do is, if you like, can you take a picture of this page? And this should help you for answering that question. Are we good? Can I move back to the question now? Great. So here we are. So required, calculate the cash flow from operations. So drop your number in the chat. What do you think the answer is? What's the cash flow from operations? Somebody said 50,000. I'm waiting for more responses. 550,000, a couple people think, okay. All right, so most people think 550,000. Okay, so the first thing we start is, as we said, is the, someone wants to tell me, what do we start with? Net income, okay, is how much? Net income is $500,000. Very good. And then what do? Even though we don't understand why, some of us, is we add back the depreciation. Thank you. Once you add back the depreciation, it was how much? $250,000. And then we said that accounts receivable decreased. So if accounts receivable is going down, what does that mean for the cash? It means that cash is going to go up. So that means we're going to add the accounts receivable of $50,000. Good. And then the next thing we're going to do is we notice that inventory increased by $50,000, 250,000. So if inventory is going up, what is happening to our cash? Is going to go down by 250. Very good. Thank you. All right, so our total is cash from operations of 550,000, okay? All right. So how was that? That's it. That's all. It's done. Great. Yoon?
Yan, yes.
Yun. Hi.
Hi. So basically, whenever we see depreciation in something like this, we always add it.
Yes.
So
Add
whenever
it back.
you should just add it back.
Just add it back.
Okay.
Right? I did my best to explain it, but I mean, if you
Okay.
don't get it, add it back. Just add it back. Right? Add it back to net income every single time. It's never going to be anything else but just add it back.
Thank you.
You're welcome. All right, we got to make our lives easier here. What is the explanation for deduct inventory? So deducting inventories. Okay, yeah, we'll practice another one at the end. So if inventory increases, so I think your problem there is you're saying, oh, okay. So if inventory goes up, right? Why is inventory in your business going up? You own a Popeyes, okay? The fries in your freezer keeps increasing. Why? No, not that inventory. The inventory that you have to sell stuff. Yeah, so your fries is going up in the fridge. It keeps going up, all the frozen fries. It's going up because you keep buying fries because you think you need it to sell it because people order fries every day. So in order for you to buy the fries, your cash has to go down. So that's why we deduct an increase in inventory from our cash. Does that make sense to who asked that question? Yeah, you're stocking up, so you're spending more cash, exactly. If accounts receivable, can you explain the accounts receivable part? Sure. So accounts receivable, if accounts receivable in this one, it says it's going down, accounts receivable goes down, that means that people are paying you the cash that they owed you for those sales that you made before that they didn't pay you for. So now they're paying it to you now in cash, the money that they owed you, so your cash is going to go up, so we add it back. The opposite is if accounts receivable is going up, then that means that a lot more people are buying from you on credit. They're not actually paying you in cash. So that means that there's less cash for you if your accounts receivable is going up. Does that help you, Jacqueline and Ciara? Okay, great. Okay, good. All right, so we're gonna move on to the next part, which is financing activities. And we talked about what financing activities is all about, raising funds. Whenever you think financing activities, you're raising the funds. You can raise funds through equity means. You can raise funds through liabilities means. And so these different activities involved through raising funds through liabilities and or equity will result in cash coming in and cash going out of the business. So some examples that are here, issuing of shares. We issue shares because we want to raise cash through equity, right? When redemption of shares, borrowing loans, repayment of loans. So these are all different financing activities that we can see in a question. So this right here really breaks it down even further and gives you a little bit more detail. So if you have an increase in long-term debt, right? What's that gonna do for your cash? If we have more long-term debt, what's that doing for our cash? More loans. Yeah, cash will increase because we're borrowing more money. That's correct. Okay, increase in long-term debt. That's gonna make us have more cash because, you know, I'm looking into getting a mortgage now. I'm gonna have more debt, but at least I'll have enough money for me to afford in my bank account for me to afford to buy a house, right? Okay, you wanna buy a car, you don't have enough, so you're gonna go get a car loan. It's gonna put you in more debt, but at least you're gonna get the cash in your bank account that you need to buy your car. Proceeds of new share issues. Yeah, always in the view of cash, exactly. And this is why we call it the cash flow statement. Always in the view of cash. Only think about cash when you're making this statement, that's it. So proceeds of new share issues, we talked about that. If we repay any of that long-term debt, now I have the mortgage, but every month I gotta pay the mortgage every single month. That's cash going out of my account. It's gonna decrease my cash, okay? Any redemption of shares, decrease cash. Payment of dividends, decrease cash. And once you go through those, you have your cash from or used in financing activities, okay? A growing company will have positive cash from financing activities. So look at chapter 6. I think it's problem 6. I think so. Let's check. Chapter 6, problem 6. Chapter 6, problem 6. Finance, yes, correct. So chapter 6, problem 6, please. Take a look at that one. And again, if you want to take a picture of this page here, and then you can use that in order to see what your answer will be. Okay, picture in 3, 2, 1. I'm taking it off now, and we're going back over to chapter 6, problem 6. All right, answers in the chat. A debenture is a form of a long-term loan. All right, somebody said 8 million. Waiting for more responses. Yes, exactly. They took out a new loan. Yep. Anyone else? Only one answer? Come on, people, be brave. Only learning moments here, honestly. It's okay if it's not correct because that gives me an opportunity to teach something. The last sentence is confusing me. I like that it's confusing you, Thomas. I like that. It is confusing you. That's good. Because I have to talk about it soon. 500,000, 5,000,000, 500,000 again. Think I'm way off. What did you get, Yun? 275,000, okay. Anybody else wants to drop their numbers in there? It's between 800,000, 500, lots of 500,000s. I wonder, how'd you get 500,000? Let's start there. Tell me how some people got 500,000. Who wants to share? 10,500,000. Tell me how you got 500,000. How did you get that? Anybody wants to share how they got 500,000? All right, so let's go in. We're looking at our financing activities. Now, again, financing activities talks about the way that we raise funds only. So somebody said, I'm confused about the last sentence. My interpretation is that the person was confused because of the $7,500,000. And I think that's exactly why a lot of people got $500,000 as their answer. Because what they did is when they were organizing the different activities in their eWeb online, they put one activity into the wrong category. We have three categories: operations, financing, investing. Operations deals with the activities that go into the buying and selling of our goods and our regular operations. Financing activities only looks at raising funds through equity or liabilities, and our investing activities looks at the buying and selling of a long-term assets. Now it says by way of mortgage on a building it bought for $7,500,000. So did we put it in the wrong spot? Did we put it in the, can you see the question? Yes, okay. 7,500,000, does that belong in financing activities or investing activities? Financing or investing? Investing. So you're gonna ignore the $7,500,000 because it has nothing to do with the financing activities. And the question says, calculate the cash used in or cash from financing activities. So $1 million we raised from an issue of common shares, okay? So we're going to, so the issue of common shares, we're going to add that. Remember, this is our financing activities section. So we're adding issue of common shares. How much was that? How much was the issue of common shares? 7,500,000? No, 1 million. $1 million. The next, this is 1 million, right? 3 and 3? No, one more. Okay. The next thing that they did was that the company paid a long-term loan of $500,000. So if you pay a loan, it's going to reduce your cash. So less long-term loan payment, $500,000. And then what happened next is that issued a new debenture loan of $2,500,000. So we will add debenture loan issue of $2,500,000. And then it says we borrowed $5 million by way of mortgage on a building it bought for $7,500,000. So we borrowed a mortgage. So we add mortgage, and that's a total of $5 million. So the total from financing activities, so cash from financing activities is a total of 8 million. All right, so how does this look now? Is it clearer now? Great, 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 great. So we had to ignore that 7,500,000, right? That one had nothing to do with what we were doing. The last bit is the investing activity, the cash used to buy long-term assets and the cash received when we sell a long-term asset. So you're going to be looking at if we invest in long-term assets, what's going to happen to our cash? Correct, correct. It's a long-term loan. So what's going to happen to our cash if we invest in a long-term asset? We buy a building, we buy a car. What will happen to our cash? Cash goes down, so we take away. Proceeds of disposal of long-term assets. What will happen if we sell an asset and we get, what do we get? We sell a long-term asset, we dispose of it, so we're gonna get some money, so cash up. And that will give us the cash used in investing activities. This one is a lot, very simple as well. So a growing company will demonstrate cash being used in investment in long-term assets. So let's look at problem 7 now, okay? So we did problem 7, we did problem 8, problem 6. Okay, so problem 7. So problem 7 said last year, Rational Co bought a new building, and that's the same one up here, right? 7,500,000. They took out a mortgage of 5 million secured against the property. The company spent 2 million on new equipment for the new property, also sold unwanted vehicles for $100,000. What would be our cash in or out for investing activities? So go ahead and work on that. Drop your answers in the chat when you're done. Can you see the question, or is it too small? No, yes, okay. Somebody says 9.5 million. Okay, that's our first guess at it. 14.4, good. I like when we get different answers. That excites me. Is a negative answer possible? Yeah, definitely possible. Not a good thing. Oh, question is not showing. I'm just gonna make this whole screen the textbook because it's better. Hold on. Perfect. Okay. 10.5, 10.6. Okay. Anybody has the same thing? Remember, you're only taking into consideration things that has to do with investing activities. We invest in our long-term assets. We buy long-term assets, we sell long-term assets. That's it. Nothing else. Anyone else still working on it? 14.5. Okay, so let's see what we have here. So we're working on question number 7. Okay. Anyone got this? 9,400,000. Jethan got that, but is yours, is it negative you have there? Okay, so it's a negative number. Okay, anybody else got 9.4? Kansas got 9.5, so pretty close. All right, so let's go through it together quickly. Last year, Rational Co bought a new building for 7,500,000. So is that cash in or out? That's gonna be cash in or out. We purchased a new building. Purchased a new building. Where does the cash go if we purchase? It goes out, right? Good. So this cash is gonna go out. All right. So then we, after that, we took out a mortgage of 5 million. Does that count in this category? No. Good. The company spent 2 million on new equipment. Is that going in or out? Why wouldn't the mortgage count? The mortgage does not count because mortgage is a financing activity. It will count in our cash flow statement, just not in this part of the cash flow statement. We already looked at that $5 million up here already when we worked on our financing activities. Now we're looking at our investing activities. Okay, Thomas? Yeah, so even if it's being taken out for investment purposes, it's going to be only under finance activities. We cannot put it in two spots. Okay, so we keep it up here in financing. We got money for that. That's one transaction. We got the money. The mortgage is just the money that they gave me. When you think of buying a house, the bank approves you for a mortgage, they give you money. Okay, once they give you money, that was a liability that you have. That is done. You've signed papers only for a mortgage. Then, once you've gotten the mortgage approved, you now go look for a real estate agent, and they will go out there and they will help you purchase a property. That's another transaction. One of them was just solely for financing purposes. The other one is the actual investment. Getting a mortgage is not an investment. Buying a house is the investment. Does that make sense? Okay. All right, so back down here. Okay, great. So the $2 million that we have here, we bought equipment. It's not letting me put it over there. I don't know why, but anyways. So this will be from equipment, right? All right, so we purchased a new building, $7,500,000. Then the company spent $2 million on new equipment. So new equipment purchased of $2 million. And then on the, we also sold unwanted vehicles for $100,000. Okay, so is that gonna bring cash in or out? Add, right? So we add the sale of vehicles of 100,000. So that gives us a total of cash out from investing activities. Does that make sense? Are we clear with that? Okay, good. So a change in cash balance. So this is a total of operations plus financing plus activities, shows how much cash increased or decreased by during the year. A company that shows decreases every year will eventually run out of cash. Not good at all right? So this was from before for our financing activities. And then any questions? Any questions at this point? Can you please go back to here? Okay, to the last solution. All right. It is negative. Welcome. All right, are we good now? So no more questions. All right, so I just put these all on the same, I just put everything here on this same slide, just so you have like a summary to refer to when you're doing your studies, right? Operating, investing, and financing activities. This is pretty much, as long as you know this, you're good for this chapter. And then we have some questions down here that we can work on quickly before we take a break, okay? So Lumber Limited made a net loss of $600,000 in 2011. And amortization expense was $250,000. During the year, accounts receivable increased from $500,000 to $550,000, and inventory increased by $100,000. Trades payable increased by $200,000. Calculate the cash from or used in operating activities. I'm gonna give maybe 1 minute for this question. This is something that you can see in multiple choice question as well. Anyone has an answer for operating activities? They made a net loss of $600,000 in 2011. Trades payable is accounts payable. Net loss has nothing to do with just cash. Net loss comes from your income statements, I mean. So when they did their revenues less expenses, there were more expenses than revenues, and so there's a net loss. Now you're going to have the net loss figure and you're going to have to work through it using the information we learned so far to figure out what your cash from or used in operating activities would be. Depreciation, you have to add it back. Depreciation is the value being lost in the long-term asset, except land. All right, so one person so far thinks it's minus 100,000. Anyone else? Minus 450,000. Amortization is depreciation. Same, it's the same thing, just a different word. Minus 400,000. Minus 300,000, okay? All right, I'm gonna reveal the answer now. The answer is minus 300,000. So we started with the net loss, we added back the depreciation expense, okay? Accounts receivable increased. So what does that mean? Accounts receivable going up means that more people are purchasing from us and not paying in cash. So we have to deduct that. Okay, so the increase was 50,000, 550,000 minus 500,000. Inventory increased by 100,000. When inventory goes up, it means that we're purchasing more, so less cash, so we deduct it. And the payables increased by 200,000, which means we're buying without paying in cash. So that means it's good for our cash flow. So we're gonna add that. So then once we calculate this, cash used is negative $300,000. Do we understand that one? Exactly, Sammy. It's just the negative, which is a net income is positive, exactly. Does that make it better now? So accounts payable was added because payables increased. Payables went up. When payables is increasing, that means that we are buying things from people and we're not paying in cash. We're actually just buying it on credit. So our cash status is better. All right, let's try another one. Calculate the cash from or used in investing activities for this one. Another 1 minute, so by 8:50, I'll ask you. Remember, in accounting, you're gonna see information that you don't need, okay? Don't use the information you don't need, ignore it. 325. Okay, a lot of people are saying the same thing. A few more seconds. Negative 325,000, okay? Okay, I'm gonna reveal the answer now. The answer is negative 325,000, okay? Great. All right, this one, calculate the cash from financing activities quickly. Financing, only look at the transactions that have to do with financing. How do we raise funds for our business? Why was net loss not included in the cash from investing activities? That's because net loss and net income only go into the operating activity side of the cash flow statement. And that's what I was saying before. We learned about these 3 separate parts. We have to learn to be very strict, okay, with our thinking. Only the things that belong in operating activities will go there. Then our financing activities will have its own. Investing activities will have its own. Net income and net loss goes into the operating activity side. That's the first thing that we start with when we're making a cash flow statement, a net income or a net loss. Does that make sense, Amin? Okay, so I'm gonna reveal the answer now. $325,000. All right. Consider each of the following independent events that occurred in Calgary Inc. in September 2011. In each case, state whether the event would increase cash flow, decrease cash flow, or leave cash flow unchanged. If we pay accounts payable of $200,000, what will that do to cash flow if we pay accounts payable? Cash flow is going to decrease, okay? What would happen if we paid wages of $500,000? Cash flow is going to decrease. What will happen if we bought inventory for $480,000 and paid in cash? Cash flow is going to decrease. Very good. What will happen if we bought inventory for $340,000 on 30 days credit? What will happen to cash flow? Unchanged. Nothing is going to happen to cash flow if we bought inventory on credit. Right? If you went and you bought a car and you said them that you told them you will pay later, does your cash go up? No change. Sold goods for cash for $900,000. That's going to cause our cash to go up. Very good. And our last one, what will be the effect of the following events on cash flow? The company sold goods on credit for $600,000. What will happen to cash flow? Is it going to go up or down? Nothing will happen. Very good. If we increase payables by $100,000, is that going to cause our cash to go up or down? So nothing will happen. Good. Paid $270,000 off for accounts payable. We paid off an accounts payable $270,000. What's going to happen to our good? It's going to go down. Very good. Borrowed a loan of $500,000. What's going to happen to our cash? Going to go up. Very good. Repaid amounts owed to credit card companies, $200,000. What's going to happen? Cash is going to go down. Cash outflow. Bought new machinery for $250,000 in cash. Cash is going to go down. Very good. And then the last one says, bought new truck for $360,000 in cash, trading in an old truck for $80,000. Will cash go up or down? Cash is going to go down. Very good. Awesome. So now we are at the point where we're finished with our first chapter 6, which, as I said before, is the one that I'm really going to guide you through so you understand it's the most difficult one. Chapter 7 is a lot more straightforward. It's just about ratios, and you're going to be given a ratio formula sheet. Anyway, now we're going to go and we're going to take a 10-minute break. So see you in 10 minutes. The time now is 8:55. So I'll see you at 9:05. If anybody has any questions, feel free to ask me now. Okay, everyone. So as you can see, I've already shared with you week 1, 2, 3 slides, just in case there were people who were not here last week that didn't get them. Now you can have access to it. Not uploading them to the e-class, no, just to answer Ciara's question, you just have to access them through here. You're welcome. So we just looked at the cash flow statement, and Raya, go ahead.
So I cannot understand the second part of the last question we did.
Okay, thanks for bringing that up. Okay, so for the one that we just did before, this is how it's broken down. We actually just put all 3 parts together. They put the cash flow in for operating, the one for financing, and the one for investing.
No, not this one. The one we had for these, like the action on cash flow, how they will.
Okay.
The number, the parts.
Okay, I will go over that after. I just wanted to do a quick wrap up of this. Okay. So cash flow from operations, and then we have the cash flow from financing activities, and then our total cash, total increase in cash. And then so we have here, because there was positive there, positive for financing. And then I believe we had a negative one for investing activities. This gives us a net decrease in cash for the year of $850,000. So this is how it would look when we put it all together, okay? Yes, you don't have access until I gave you access after class, okay? And if 1 and 2 are the same link, I will have to make that change, but not now. All right, okay. So let's go back to this slide so I can clarify this question for our friend here. Hold on, pull it up quick. Okay, which one was it? Sorry.
Not this one, no. Last question. Yes, this one, the B part.
B.
So why there? Yeah.
So we increased our payables by $100,000. So
cash will not increase.
Oh, so you're referring to how we will rationalize the change in working capital in our cash flow statement, right?
Yes.
All right. So what we're doing in the cash flow statement is we start with our net income, our net loss, we add back the depreciation, and then we're looking at, okay, what happens if accounts receivable goes up or down? What happens if accounts receivable of accounts payable goes up or down? So yes, in your cash flow statement, you would have added that back if the payables had increased. You would add that back to your net income figure. But this question is asking us, in each case, state whether the event would increase cash flow or decrease cash flow. So, or leave the cash flow unchanged. So think of it, if you buy something, I buy fries, I own a Popeyes, I buy fries from a supplier and I don't pay them in cash, right? Is that going to cause my cash flow to go up? Is it going to cause my cash flow to go down, or nothing's going to happen to my cash flow?
But if we are doing it like in a question, then we will add it.
Yes, if you're doing it if you're making a cash flow statement, you're going to add it back. These are just trying to see if you understand what happens to cash flow if these different events occur.
Okay.
Okay?
Okay, thank you.
You're welcome. So for chapter 7, we're just going to be looking quickly at financial statement analysis. And this is where they give us a bunch of financial statements, and now we know what all of them are. And we are able to calculate different ratios to assess the financial state of the business. All right. So I'm going to start off with a quick video just to give you guys a break from my voice.
A ratio analysis explained in 3 minutes. Sometimes it's not enough to simply say a company is in good or bad health.
To make it easier to compare a company's health with other companies, we have to put numbers on this health so that we can compare these numbers with the numbers of other companies. So now, how do we use numbers to assess company health? This is where financial ratios come in. Very common types of financial ratios are liquidity ratios, profitability ratios, and leverage ratios. Liquidity ratios can tell us how easily a company can pay its debts so that the company doesn't get eaten up by banks or other creditors. An example of this is the current ratio. This tells us how much of your company's stuff can be easily changed into cash within the next 12 months so that it can pay debts which need to be paid also within 12 months. The higher your current ratio is, the less risky a situation your company is in. Now moving on, profitability ratios can tell us how good a company is at making money. An example of this is the profit margin ratio. This tells us how much profit your company earns compared to your company's sales. Normally, a higher number is better because you want to earn more profit for every $1 of sales that you get. And finally, what about leverage ratios? These can tell us how much debt the company is using to make the company run and stay alive. An example of this is the simple debt ratio. This tells us how much percentage of a company's assets are paid for by debt. Normally, a company is considered safer when the debt ratio is low. Note that this was just a very simple overview. There are a lot more financial ratios and many different ways of using them, plus a lot of problems and disadvantages in using them as well. Would you like to super easily learn more about many financial ratios with even deeper analysis and detail? Check out my free videos at mbabullshit.com. See you there.
All right, so the reason why I let that play for the whole time is because this website is very helpful, a very helpful resource that you can add to your resource bank for studying for this. Ria, go ahead.
That was from before. Thank you.
Sorry? Oh, from before. Okay.
Yeah.
Okay, so if you go on to this mbabull.com, on here, it has a segment on financial ratio analysis tutorials. So if you go in here, there's a lot of different videos that are for each of the ratios, which I find will be very helpful for all of you. So a video on each ratio. Just to let you know, for the ratios, all you really are expected to do is know how to take numbers out of your financial statements and plug them into a formula. For your midterm, your formula sheet is going to be allowed. You can use your formula sheet in your exam. So don't worry, no need to memorize your formulas. Okay, you don't need to memorize the formulas. We give you the formula sheet, it's already uploaded on the e-class. Once you get your formula sheet, you will have a question that asks you, for example, can you find this current ratio for this company? You just use the numbers that they gave you, plug it into your formula, and you have your answer. Another thing that you may need to do for a couple of multiple choice questions, maybe, another thing you need to know for this is how to explain in very simple terms. Does this, for example, if you're calculating a profitability ratio, like does this ratio mean that the company is doing good or bad, right? That's pretty much all that you'll need to know for this chapter. So your ratios, no need to memorize them. They're given to you. You can use them in your midterm. Know where to find the information to plug it into your formulas. And then is it a good answer or is it a bad answer, right? Does that mean our company is profitable or does it mean it's not profitable? Does it mean our company is liquid or is it not liquid? Okay. So that's that part here. All right, moving along. The accounting equation as a framework for financial reporting. As we mentioned before, there are 1, 2, 3, 4, 5 categories of the ratios: liquidity, profitability, debt, efficiency, and market ratios. And what happens here is that we have just summarized the different financial statements. And as we know, we are going to be using these ratios to analyze our financial statements. So balance sheet, we're going to use a couple of ratios in order to analyze the balance sheet and what is that balance sheet really telling us about the financial situation of the business. Okay. So for liquidity, is the company able to pay off its immediate debts or is it going to run out of cash? So how liquid is a company is telling us if this company is in a position to be able to have enough cash so that it can pay off immediate debts. Okay, a profitability. So we're looking at how well is the company doing in terms of its profits? how well is the company able to earn profits, right? Then we have ratios that have to do with debt. So debt ratios, does the company have too much debt? So it's comparing the debt situation of the company. So there is an equation called debt to equity ratio in there as well that you will see. Then there's efficiency. How well is the company using its assets in order to generate sales or generate revenues? And then there are market-related ratios, okay? What are the earnings of the company and the dividends, right? So for each of these ratios, and I'm gonna jump over to the E-class now quickly so that you can see what that ratio formula sheet looks like. So it's right here. So this is what it looks like. It breaks down the ratios under liquidity, profitability, debt, and efficiency. The formulas are all there. So you're literally just going to be plugging in numbers into these formulas. It's very, very, very simple. So don't worry about having to memorize anything. All right. And this here is just a list of all the different ratios. Again, those are already placed in your formula sheet, which you can use in the midterm. So for example, here we see that you have a bunch of financial statements. This one shows your balance sheet for 2007, 2008, 2009. And then this one shows our income statement for those same years. Then we have our statement of retained earnings for 3 years. And then we have our statement of cash flows for 3 years. And we just learned how to do this, right? So this we know from today how we will create it. So if we're looking at liquidity, right? Two ratios that we can calculate in the liquidity section are the current ratio and the quick ratio, all right? I'm gonna play a quick video of the current ratio, and then I'm gonna ask you to calculate the current ratio for me, and then you'll get an idea of how easy this chapter is just because you're given a formula sheet. Some classes, like when I did accounting, I did not get a formula sheet. I had to memorize all of these equations on my own.
He has $1,000 in current assets, not $1,000 in assets, $1,000 in current assets, and $800 in current liabilities. Now, just a reminder, what are current assets and liabilities? These are assets or liabilities which are convertible or which will turn into cash within the next 12 months. So if it's a current liability, it is due within, or needs to be paid within the next 12 months. Current assets are assets which you can easily convert into cash within the next 12 months. So now, what is the current ratio? Well, it's very simple. Current ratio is $1,000 divided by $800. Where did we get this? $1,000 is $1,000 in current assets, and the $800 is the $800 in current liabilities. And the current ratio is 1.25. Now, the more important thing is, now this is very easy to compute. So the more important thing is, what does this mean? What does 1.25 mean with the current ratio? Well, it means that the company has 1.25 times the amount of current assets to pay for its current liabilities. Or another easier way to understand it, if you don't understand the meaning of 1.25 times, is that the company has an excess of 25% in current assets to pay for its current liabilities. It has more than enough current assets to pay for its current liabilities.
Professor, we can hear you. Thank you. I'm sorry about that. So if we have our current ratio here and we want to calculate current assets divided by current liabilities, which statement will we look at for that? Which statement, which financial statement are we going to go look for the information to plug into this formula? Current assets divided by current liabilities. The balance sheet, very good. Good job. So we go up to the balance sheet, which I think was the first one. Good. And we're looking for 2007. Current assets is 252,885 divided by current liabilities is 126,837. So once we divide that, here we'll get 1.99. Okay, so can you go ahead and calculate it for 2008 and for 2009? Current assets divided by current liabilities. 2008 and 2009, what did you get? Put your answers in the chat when you're done. 1.07, okay, 1.07, all right. And for 2009, all right, so let's see if what we got was correct. Okay, so did anybody get 2.06? Okay, so why did so many people get 1.07? Anyone got 2.34? Good, I see 2.34. People who got it wrong, do you know where you made the mistake? Sure. Balance sheet. So total current assets, maybe you guys use your total assets, not the total current assets, divided by the total current liabilities. Total current assets divided by the total current liabilities. Okay, all right, good. So we understand where we made a mistake. Quick ratio is just like the current ratio, except we're going to be taking out our inventory, all right? So we're taking out our inventory. So current assets less inventory divided by current liabilities, okay? So again, the current assets, we deduct our inventory. So if I go back up to the statement, current assets here, 252, we deduct, we're taking out the inventory, and then again, divide by current liabilities, okay? So what is it for 2008 and 2009, the quick ratio? Current assets less inventory divided by current liabilities. Any thoughts on that? I just want us to get practice calculating ratios so that you're not intimidated by them. Somebody said 1.59 for 2008 and for 2009. 1.39 for 2008, okay? I really wish I can see more answers in the chat. 1.34, all right. So for 2008 and 2009, correct, 1.34 and the 1.66, so correct, all right? All right, so based on that, would you say that Leon's business is liquid or not? Is it sufficiently liquid, improving? So do you think it's a liquid business or it's not a liquid business at all? What do you think based on the results here? They're liquid, yeah, because they have a lot of assets. They're able to pay off their current liabilities. Good, and then is it improving? Do you think it's improving? Yes, it is improving. Good job. So that's pretty much it. Like that's what you have to be able to do. Okay. Look in the statement that you need to look in, plug in the numbers into your formula, put the answer down, and maybe you might have to, for a couple of questions, figure out how can you analyze and to talk about whether or not is it profitable, is it not profitable, is it improving, is it not improving, of the sorts. Okay. So I'm gonna go through a couple more, but I'm not gonna go through all of the ratios with you, just because, especially the way that these slides are set up, I've put in lots of videos in there, and I've given you lots of other resources that you can use from the MB Bowl website as well. So I'm gonna go through a couple more, and then we're gonna talk about the midterm, because I really wanna have some time for us to talk about the midterm coming up, okay? So for profitability ratios, we're going to talk about return on sales, return on assets, and return on shareholders' equity, okay? So the first one is the return, gross profit on sales, right? So gross profit on sales, the formula is gross profit divided by sales times 100%. This ratio measures what is left over out of sales after we deduct the direct cost of sales. So gross profit, which statement are we gonna go to find our gross profit? Remember, gross profit, which statement deals with profit? What statement deals with the profit? Anybody remembers? Income statement, very good. So we go to the income statement, and we're gonna look for our gross profit, and then our sales, okay? So gross profit, 274,195 over 637,456 times 100 gives us 43%, okay? Gross profit divided by sales times 100%. So who wants to tell me what will our gross profit on sales be for 2008? Gross profit on sales for 2008. All right, 40.5. 40.5, good. Samin, you forgot to divide that by your sales. Okay, and for 2009, 40.3 for 2009. 40.3. Okay, all right, let's double check. And you guys were correct, okay? So that's how we calculate our gross profit on sales. And then we have our return on sales. So that's your operating income divided by your sales figure. And again, you'll go to your income statement and you'll get your operating income. And then you'll divide it by your sales amount, okay? So then this slide is showing you that we can calculate, use vertical analysis, and we're expressing each item as a percentage of sales revenue. So we can express gross profit as a percentage of sales, operating income over sales, salaries over sales. We can do that for all of these different parts of the income statement, okay? Then there's return on assets, right? Return on assets. So our operating income divided by total assets times 100%. Remember here, it says total assets, not current assets, not long-term assets or fixed assets, total assets, okay? So as I said before, it's very, very straightforward, chapter 7, just being able to find the numbers that you need, plug them into your formula sheet, calculate the amount that you have, and being able to understand, is this a good situation for the business or is it a bad situation for the business? Is it improving or is it getting worse? All right, so all of these slides will be available to you as well. All of these are already uploaded on your e-class. Actually, I just copied and pasted them into this slide deck, so you don't have to go to 2 places to grab them. If you meet up on this is a hyperlink, so you can click on it, and it will take you to another helpful resource to help you to understand that section. All right. So what I'm going.
So previously, when we're using.
is I'm going to stop there now with chapter 6 and chapter 7. If anybody has any questions for me for chapter 6 or 7, please let me know now. Questions for chapter 6 or 7. Also, another reminder is that Taslima has posted her lecture from a previous semester, and she will also be uploading her lecture from this semester as well. Taslima may have gone into financial ratios in a bit more detail than I did. I'm not quite sure, but it'll be worth it to check if you're looking for some additional understanding on the financial ratios. So no questions. So how do we feel about chapter 6? How do we feel about chapter 6? On a scale of 1 to 10, 1 being really bad and 10 being really good. Yeah. Yeah, chapter 6 is definitely a lot more confusing, and that's why I realized that I have to spend most of my time on that. Yeah, don't neglect ratios either. Don't neglect it. Practice it. Practice all of the assigned questions for your tutorials and the ones that your self-study problem for this one as well, for chapter 7. Yeah, I will repost the links to the slide in a bit, but I just want to go over the midterm first. Any other questions? All right, so yes, you do have to practice more, practice as much as you can for all of the chapters. Chapter 1 is, okay, so you know what, before I go into that, let me go to your e-class. And I'm going to start our conversation on our midterm. All right. So midterm number 1 is scheduled for Saturday, February 5th from 2 to 3:30 p.m. It'll be done on this e-class platform right here and nowhere else. Tutorials, there are past tutorials I think that are already uploaded on there already, some videos uploaded. The tutorial sessions themselves, no, are not recorded. Okay, so this section here is very, very helpful to everyone. And the reason why it's helpful is that there is a midterm 1 review checklist. Which other class gives you a checklist, right? So what this does is it lists out very detailed. It's super detailed. Some professors might think this is too detailed, right? But we know that this is a difficult and challenging class, and we understand that most people are not accounting majors. So we try to make it as, we try to set you up for success, okay? So we're gonna have 35 questions, 1 point each. Both conceptual and calculation. So 10 to 12 conceptual questions in multiple choice format, 25 to 23 calculation questions where you have multiple choice questions as well as fill in the gaps. All right. Total marks, 35 marks. The weight of this exam is 25% of your grade, and it will be, as we said before, 90 minutes, 1.5 hours. We go down and we notice it tells us exactly what you should be looking at for each of your chapters. So chapter 1, as I said in the beginning, it's not heavily tested at all in your midterms. There's just a couple of conceptual questions that you'll have to prepare yourself for this one. So for this, I would say read over your slides, maybe just take a quick breeze through of your chapter 1 textbook, just for when just for a couple of questions that are gonna come up in chapter 1. It also gives you here practice materials, what you can look at to help you prepare. Chapter 2, there will be a basic idea of types of financial statements, so some conceptual questions there. Your accounting equation. Remember, we went through a lot of practice on our accounting equation. So there will be calculation questions for that, right? So we give you a certain transaction, and you have to figure out how is that going to affect assets? How is that going to affect the right side of the equation, liabilities or equity? Understanding the flow in the accounting equation is going to be important. Then there'll also be questions on your conceptual framework, which would be all of the concepts that I had included in that diagram at the end of your slides for lecture 2. And I will also add that conceptual quiz to the midterm section. The quiz that we did in the last week's class, I'll add the questions there as well, so you can have additional practice for that for a conceptual framework. So you're going to be looking at things like reliability and relevance and going concern, all of those types of concepts, being able to understand what all of those things mean. So for chapter 3, you're going to have to remember the concept of revenue recognition. And we've talked about that so much, right? I think that this class should be okay with that, but go over it again. The criteria for revenue recognition for goods and services, conceptual and calculation questions, concept of expense matching, especially cost of goods sold, cost of sales. We talked about that. Criteria for expense matching. Okay, so concepts of different profit calculations, such as gross profit, operating profit, and net income. We learned about the differences between those three, right? How do we, so we start with sales, we know that. How do we arrive at a gross profit? What do we deduct? Sales less nobody remembers how to get gross profit? Sales less something gives us gross profit. Sales less our cost of goods sold gives us our gross profit. And from our gross profit, we deduct something to get to our operating profit. What do we deduct from our gross profit to get to our operating profit? Operating expenses, very good. And then what do we deduct from our operating profit to get to our net income? Tax and interest. Awesome, good job. See, people have learned. Concept of amortization. Somebody asked, what's that? Well, it's depreciation. It's the same thing, understanding how to calculate that. Conceptual plus calculation will come in for that. Okay. Concept of retained earnings statement. So we worked on that statement as well. Chapter 4, it breaks down what we need to know for this chapter as well. So chapter 4 was when we really zoomed into our balance sheet. So how to create a balance sheet, the different parts of the balance sheet. So as you know, it's not going to be a long answer type of exam. You have to just maybe fill in a box, a little box where you put in an answer. We can give you some information and ask you to calculate what the total assets are. What are the total current assets? What's the total equity, right? So being able to understand exactly which items go under each category will help you when trying to calculate that. Chapter 5. So chapter 5 was where we looked, we zoomed into still the balance sheet, but we focused more on the liabilities and the equity portion of it. So there will be a combination of conceptual and calculation questions for this section as well. Okay, dividends and its effect on owner's equity. What does dividends do to owner's equity? It decreases it. Very good. Good job, everybody. For chapter 6, this is what we did today for our cash flow statements. All right, so conceptual and calculation questions for those. For chapter 7, understanding the reasons of calculating different ratios. Okay, so why would we need to calculate profitability ratios? Why would we need to calculate liquidity ratios? What does the leverage or the debt ratios have to do with anything? The market related ratios, and all of those videos that I linked into your slides will really help you to explain this part so that you can answer your multiple choice questions. Right? How to draw a decision based on the numerical analysis. So basically, if you calculate a ratio, what does that ratio say? Is the company profitable? Is it not profitable? Right? So if the company is liquid, is it not liquid? If the company is not profitable or it's not liquid, if I'm an investor and I want to invest in that company, should I, if it's not liquid or it's not profitable, right? So those are some of the things that you will be able to answer. All right, so for chapter 7, some good examples of exam type questions will be problem 1 and the self-study problem. So again, really go over this document here where it breaks down in real detail exactly what you will expect for the types of questions on your midterm. And then you can go through the different materials that we suggest for practice. You will not be able to go back and forth between questions, no. Okay, so something else on the E-class. So we have a practice midterm here for ADMS 1500, comes from winter 2019, and another one, practice midterm 1. So 2 practice midterms, okay? I wish that next Monday's lecture will be a review. Honestly, I wish it was, but because of how tight this course is, we need to use Monday to start our first 2 chapters of managerial accounting. I know, it is really sad. I know, I'm sorry about that, but it's out of my control. All right, so I would say that all of the chapters are pretty heavy except for chapter 1. So it's just kind of an equal distribution for all of the chapters except for chapter number 1. It wouldn't confuse you because managerial accounting is very different from financial accounting, so it will be fine. All right. So what I will say is please practice now as much as you can for your midterm. Don't wait until the last minute at all. Okay, so we have some practice questions here that I will go through a couple of them for like 5 minutes with you. But before we do that, there's one more thing I wanted to tell you. Your 3 quizzes here, make sure you do them just before your midterm, maybe a day or 2 before your midterm, just so that you get some more practice on the concepts that will be covered in the midterm, because it's the same concepts that are in those quizzes. And then there's a practice midterm 1 online format. So when you click on this, it's going to show you what you're going to see when you do your actual midterm. So you can go ahead and practice your practice midterm. You get to see exactly how the E-class is going to be set up during an exam environment. No, the quizzes are not timed, and you have 2 tries. Okay. All right, so using accounting for decision support within the organization requires general purpose financial reports, such as the income statement and the balance sheet, specialized reports, budgets, or personal financial planning, or none of the above. What do you think? A lot of people think A. So using accounting for decision support within the organization requires general purpose financial reports, such as income statement and the balance sheet. Okay, the answer is B, specialized reports. Number 2, financial statements are required to be produced by who? Tax law, the Canada Business Corporations Act and its provincial equivalents, the accounting equation, generally accepted accounting principles. Everybody thinks B, the Canada Business Corporations Act and its provincial equivalents. Some people say D, generally accepted accounting principles. Okay. So the answer is D. All right. Number 3, the purpose of the statement of retained earnings is to do what? Measure changes in owner's equity, measure the effect of net income on equity, measure the effect of dividends in reducing owner's equity, all of the above or none of the above. D and B. So D's and 1B. Okay, on the first quiz, the answer for question 2 was B. Can you please send me an email about that, please? Write the question down and write your query, okay? So I can look into that. Thank you. All right, so what do you think for the purpose of the statement of retained earnings? Most people said D, all of the above? Correct. Business entity, historic cost, going concern, periodicity, disclosure, recognition, and matching are all examples of accounting concepts, relevance in financial statements, reliability in financial statements, desirable characteristics of financial statements, are none of the above. A, accounting concepts, somebody says, okay. Anything else? B, relevance, okay. Okay, lots of people think B. So the answer is A, accounting concepts. All right, last one I'm gonna do with you is investors buy shares in Quietus Limited for $5 million. On day 1 of the company's operations, $3 million is spent on assets and $4 million is borrowed from the bank. By the end of the first month, they have also bought $10 million of goods for resale on credit and made sales of $25 million on credit. The remaining inventory had a cost of $3 million. Ignore all other transactions and expenses. What's the operating profit for the month? Operating profit. So operating profit, we know it comes after the gross profit. This profit is in the income statement. Where do we start? I see A, B, 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 and a C. And a B. All right, so the answer is C. So only one C. Okay, so Tharoon, can you tell us how you got C before we go? No, you don't need to join a meeting. Oh, that's a good thing you brought that up. On the day of the meeting, there is going to be a help desk. A help desk is a Zoom link right here that's on there. If you have any questions, technical issues, anything that happens during the exam that's technical and not for concepts, I cannot tell you answers or help you with answers or anything like that. Join this Zoom link. I'll be there waiting for questions, okay? So back to this really quickly. How did we get 18 million? What did you do? How do we find gross operating profit? Sorry, what's the equation for that? The next question is 5 million in shares, 3 million spent on assets, 4 million borrowed from the bank. Does that have to do anything with finding the profit? No. Okay, it has nothing to do with the profit. So we're only looking at the end of the first month. They bought 10 million of goods for resale. We know that. So this is by purchasing, and then here the remaining inventory is the ending inventory. How do we find the cost of goods sold? How do we find cost of goods sold? So exactly, so cost of goods sold is equal to so we have the opening inventory, which is 0, add purchases, this is so hard to write, add purchases, and that was 3 million, was it 3 million? 10 million, sorry. So that's our cost of goods available for sale, cost of goods available is equal to 10, less our ending inventory, of $3 million leaves our cost of goods sold as $7 million, right? So then we have our sales amount, 25 million, less our cost of goods sold will give us 18. Does that make sense? So sales less our cost of goods sold. Okay, people are lost on this. All right. Okay. So our income statement says that we have sales revenues of 20, okay, sales revenues less cost of goods sold equals gross profit less operating expenses equals operating profit less, less. Okay, let's stop there. That's income, interest, and tax, but let's stop there. So sales revenues less cost of goods sold. So sometimes it will give you cost of goods sold, but sometimes you have to find it. And remember, cost of goods sold is opening inventory, add purchases is equal to cost of goods available for sale less ending inventory is equal to cost of goods sold. Do you remember this? So if we have our sales as 25 million, oh, you cannot see what I'm typing? Do you see it now? Good. All right, so sales revenues less our cost of goods sold, and our cost of goods sold is opening inventory, add purchases gives us cost of goods available for sale, less ending inventory gives us cost of goods sold. So once we deduct that from our sales revenues, we get gross profit. And then we less our operating expenses to give us operating profit. But they did not give us any operating expenses in this one. So we assume operating expenses is 0. Do we get it now? So what is the cost of goods sold? The cost of goods sold is 0, which is opening inventory. Add purchases, and purchases is 10 million. Gives us cost of goods available for sale of 10 million. Yeah, maybe. Yeah, I don't know. Maybe everyone is just really tired. Yeah, so maybe if you don't understand it again, just send me an email and I will explain it to you there. Okay? Because we're 10:04 and I know that people are really tired. Or maybe you can, if you want, you can stay back and I can help you after class. Okay. All right, so that's it for today's class. Practice all of the midterms that were posted. Do your quizzes, practice all of the assigned questions for tutorials as well as our in class, and you'll be fine for the midterm. Okay, good luck everyone and see you next week. Have a good night. The midterm average is usually pretty low. No need to show workings, just put in the answer. Bell curving happens during the finals at the very end. A bell curve is where we adjust the grades if the average is too low. It's the lowest for the first midterm. The second midterm is usually the average goes a bit higher because students are better at managerial accounting. Okay, so practice as much as you can. Yeah, so you're gonna have to work really hard so that you can get, I want everybody here to get a lot better than C+, honestly. Yeah, extra help from tutorials are always there on Saturday. If people get C+, yeah, people get A's, B's, C's, C+, people fail, like all courses. But if you practice and you work really hard, then you'll do really well. Just have to really, really work really hard. Have a good night.